Okay, let's talk about scalping. If you're looking for fast results and you absolutely hate the idea of staring at charts all day long, scalping is an incredibly effective approach. But, and this is a massive but, it only works if you're operating with a really rigid system. So, in this explainer, we're going to take some advanced, smart money concepts, blend them with pure price action, and distill the whole thing into a battle-tested scalping playbook featuring 3 distinct, highly actionable setups.
Here's the game plan for today. First, we'll lay down the law with scalping and risk management. Then, we dive into the setups. Strategy 1 focuses on fair value gaps, Strategy 2 is all about hunting liquidity, and Strategy 3 strips it down to pure price action. Finally, we'll put them head-to-head in a strategy comparison.
All right, Section 1, Scalping and Risk Management. These are our baseline rules of engagement.
Listen, because scalping lives on the 5-minute or even the 1-minute charts, you are inevitably going to face a ton of false signals. It's just the nature of the beast. So to protect your capital, you have to follow these core principles religiously. Notice that second point about trading major pairs? That is absolutely crucial. If you're targeting a quick 10 to 20 pips on, say, Euro-USD, the low spread makes it smooth. But if you try that on a minor or exotic pair with a wide spread, the spread alone will literally eat your profits alive before the trade even gets going. Also, stay out of choppy markets. And remember, scalps are supposed to be fast. If you're sweating over a position for 3 hours, you're not scalping anymore, you've accidentally become a day trader.
Okay, let's get into the actual setups. Section 2. Strategy 1. Utilizing fair value gaps, or FVGs. So, what exactly is a fair value gap? Think of it like a giant magnet on your chart. When the market moves violently in one direction, it leaves behind an imbalance, a literal gap in fair pricing. Now, the market hates imbalance. It actively wants to fix it. This means price will very often pull back to these specific zones just to fill that gap before it resumes its original trend.
Trading this takes some serious discipline, though. We don't just guess. Step 1, you zoom out to the 30-minute chart to establish your overall narrative. You're looking for a break of structure to confirm a continuing trend, or a change of character to signal a reversal. Once you've got that, mark your 30-minute fair value gaps. Then, and only then, do you drop down to the 5-minute chart. At that point, you just sit on your hands and wait for the price to pull back into that zone.
Once price actually taps into your 30-minute zone, you need a precise trigger on the 5-minute chart. You want to see the price wick above a previous swing high or below a swing low. That is your liquidity grab. The exact second that sweep is confirmed, you enter the trade. Your stop loss goes safely right past the tip of that wick, and your take profit target is the next major level on the 30-minute chart. Doing it this way seamlessly combines higher timeframe momentum with exact lower timeframe precision.
Moving right along to Section 3's Strategy 2. This one is entirely focused on liquidity. Basically, we're hunting where the stop losses are. The core concept here is the draw on liquidity. Again, think of this like a magnet. The big financial institutions, the smart money, they need massive amounts of liquidity to execute their huge orders without slipping the price. So the market naturally gravitates toward areas where everyday retail traders have parked their stop losses or pending orders. To spot these magnets, you look for obvious resting orders on the 30-minute chart. A perfect example? Equal highs. If you see 2 peaks stopping at the exact same price, what most people call a double top, retail traders are conventionally taught to put their stop loss just above it. That creates a massive pool of buy-side liquidity. Smart money knows exactly where those stops are, and the price will literally be drawn up there just to sweep them out.
So how do we actually capitalize on this? Well, step 1 is finding that obvious liquidity pool, like those equal highs on the 30-minute chart. Once you know price is being drawn up toward that level, you switch down to the 5-minute chart. But here's the really fascinating part. You actually wait for a liquidity grab in the opposite direction. So if your main target is way above you, you wait for the 5-minute chart to suddenly sweep a low. This traps a bunch of impatient sellers right before the market reverses and launches up toward your true target.
For your entry, you've actually got 2 distinct options here depending on your style. If you're aggressive, you can enter the trade the exact second the price snaps back into the range after that opposite fake-out sweep. Or, if you want to be a bit more conservative, wait for a new 5-minute fair value gap to form in your direction and set a limit order right there. Either way, tuck your stop loss just behind that fake-out wick to give the trade some breathing room,
and aim for that massive 30-minute liquidity pool we identified in Step 1.
All right, on to Section 4, Strategy 3. This is pure price action specifically focusing on the breakout zones flip.
The logic behind this third strategy is totally foundational. It's old school, but it is incredibly reliable. It's the classic support and resistance flip. When a ceiling of equal highs gets broken, it turns into a floor. When a floor of equal lows is shattered, it turns into a ceiling. We're looking to trade that exact transition.
Because this relies on pure price action. It technically works on literally any time frame, but the sequence of steps is completely non-negotiable. First, you have to identify a clear, undeniable trend. Let's assume it's an uptrend. You wait for equal highs to form, and then you wait for price to aggressively smash right through them. That old supply zone has just become a demand zone. Now, the hard part. You wait. You sit there and wait for the price to pull back and touch that exact breakout zone.
The absolute key here is confirmation. If the price pulls back to your zone and just slices straight down through it, skip the trade. The zone failed, no harm done. To actually confirm the entry, you can either wait for a single candle to close above the previous candle's high right at the zone, or for a really refined entry, you can zoom into an even lower time frame, draw a little trend line over the pullback, and buy the exact moment that mini trend line breaks. That break proves the pullback is over and the main trend is back on track.
Now, before you execute any of these three setups, you have to obey the ultimate rule. Always check the higher time frame. You could spot the most beautiful 5-minute setup in the world, but if there's a major daily or 4-hour resistance level sitting just 10 pips away, right in front of your target, you're basically driving a sports car straight into a brick wall. Always make sure there is clear, open air for the price to run.
Okay, Section 5, the Strategy Comparison Table. It's time to choose your weapon.
Let's synthesize all this and weigh the pros and cons. Strategy 1, the FVG pullback, is absolutely fantastic when the market is trending smoothly, but it will literally chop your account to pieces if you try to force it in a sideways market. Strategy 2, trading liquidity, makes you the hunter. It's amazing for capitalizing on retail traps, but man, it demands serious patience to wait for those counter-trend sweeps. And Strategy 3, pure price action, gives you ultimate flexibility across timeframes, but it requires you to be hyper-aware of the bigger picture so you don't accidentally trade into those higher timeframe roadblocks.
So as we wrap up this explainer, I want to leave you with a thought. Which of these three structured setups actually matches your personal discipline and trading psychology? Trading isn't really about finding some magical, perfect pattern. It's about finding a system that you can execute flawlessly, without emotion, day after day. Which of these rules best keeps your own emotions in check? Pick the one that resonates, backtest it relentlessly, and really master your edge. Until next time, manage your risk and stay sharp.